Hello, everyone, and welcome to another episode of the Indy Real Estate Investing Podcast. I'm your host, Jeremy Tallman, and it's just me today. I do this from time to time. It's been a while, but there's no guest today. It's only me. I want to talk about something that I hear from time to time from some of our clients, from just investors at large. And these can be new investors. It could be investors that have owned a property for maybe 1 or 2 years, or it could be super seasoned investors. And it goes something like this. It says, this property just doesn't cash flow. So it must be a dud. And I think I might sell it. I think I might do something else with it because it's just not working out as a rental property. And I totally understand that sentiment. Cash flow is a very tangible thing. It's the thing that hits your bank account every month, or at least you hope some cash hit your bank account every month. It's likely the only KPI that a lot of investors measure. And when it's negative, or when it's very slim, or if you're ever contributing money to the bank account to pay bills, that can be a very defeating feeling. And the reason is, I think cash flow is such a difficult thing today is that, and it's not a surprise, it's just a lot more expensive out there to do things. I'm constantly, literally like almost every week, or at least every month, experiencing some sticker shock out there for what it costs to do things. With our own investments, with my home, let's say, it's just really expensive to get good quality work done out there. And I get it. It's as tough as it's ever been to be a landlord. And I certainly understand the sentiment of feeling defeated and that a property's a dud. But I want to make a case today that looking at cash flow could be considered one of the most expensive, let's say, misreads out there for investors. Because while you're staring at the cash flow and calling the property a dud, the property is very likely doing 3 or 4 things in the background that's building your wealth in ways that you may not feel every day. So by the end of this episode, I want to give you one simple habit, something that Scott and I do every year, sometimes a couple of times a year, that it's going to take you about 20 minutes is all. Simple little habit that I think will hopefully change the way you look at and evaluate whether a property is a success or not. All right, let me give you a quick hypothetical. Let's say you bought a single family here in Indianapolis 2 years ago for $220,000. You put 20% down, that'd be $44,000. You finance the rest. The tenant's been there, rent's covering most of the, if not all the expenses. But after everything, let's say you're clearing maybe $100, $150 a month. Some months it may be less than that. Some months it may be more than that. Some months you may be contributing into your operating account to pay for things. And like I said earlier, that's a real threat in today's market where you're going to have to contribute to your operating account just to pay the everyday expenses that you hit. So on its face, it's not a great scenario. You're starting to wonder, again, like a lot of investors have been doing, if this was a mistake, whether the property was a mistake, or maybe just getting into real estate investing, period, was a mistake. But let me pause for a minute and make you think about something a little different. Because here's what's actually could be likely happening in the background. First, yes, there is some cash flow, maybe a little bit, maybe $100, $150 a month. Again, maybe there's none. But let's say that most months, over a given period of time even, that the resident is paying for your mortgage, maybe a little bit more. But I'm not going to focus on cash flow here. But let's just say that there's a given, maybe there's a little bit of cash flow there. Second, what is happening every month? And I get pushback from some people that say, this whole mortgage pay down, it just doesn't really happen the way a lot of people think. And I get it. So let's say that every single month, let's say you're in a 30-year mortgage, a portion of your payment, albeit at the beginning it's going to be very small, is going toward that mortgage balance. So every single month, your mortgage is getting smaller. So let's say with that example I used earlier on the property that was purchased here, let's say you financed with a 30-year mortgage. So you have about $176,000 financed. So in that first couple of years, year 1, year 2, you're paying down approximately $2,500 to $3,000 in principal every year. And again, that's real money. That money didn't just go to the bank and go to their profit line. Your interest certainly did, but it's paying down that debt every single month, every single year. So just think about that. Maybe $2,500 to $3,000 in principal pay down a month. Third, the property most certainly is going to increase in value every year. It's not a given, but generally speaking, Indianapolis, it's a super steady market where investors come. They like it. They like how predictable Indianapolis is. So it's not a speculative market. It's not dramatic in the shifts that we see either way, but it's consistent. And so let's just say at a conservative 4 to 5% annual appreciation, a $220,000 home, which is what you had presumably when you purchased it because you had your appraisal done. If it adds, again, 4 to 5% in appreciation, that's somewhere between $15,000 in that first year. And you didn't necessarily do anything for that. You just owned it, right? But it is starting to add to your wealth, and in this case, pretty significantly. And then fourth, as you should know, the IRS does let you depreciate the structure. So residential real estate, for those you don't know, depreciates, the schedule is about 27 and a half years is how properties are depreciated out. So on a property that's, let's say the building is assessed, because it comes down to what the building is worth, not the land around it. Land does not depreciate. Let's say that value is, say $175,000. That's going to be about $6,400 a year in depreciation deduction. And depending on your tax situation, you need to really get, huddle up with your CPA here. But that's likely going to shield you from around $1,500 to $2,000 a year from income taxes. So it's real money. You never see that line item anywhere unless you actually talk to your CPA and really dig into your tax return about what that does. So let's add that up. Let's say $1,500 in cash flow. We'll talk about that here in a minute. $2,800 a year in principal pay down and $15,000 a year in appreciation, and then $1,700 a year, let's say, in tax benefits. So, that dud property generated nearly $21,000 in total return in that given year. And on a $44,000 investment, remember, you paid $44,000 down. You didn't put the whole $220,000 down. That's close to a 50% return on your invested capital in year one. And you'll almost never get that type of return in the stock market. And let's just eliminate cash flow altogether. Let's say you cash flow zero. All those other drivers, though, still make that return about 44%. It's amazing. So on a cash flow neutral property, you return 44% on your money. Now, I want to be careful here. Like I said earlier, appreciation is not guaranteed. I'm giving you estimates. Some years it may be more. Some years it's probably going to be less. So I want to be really careful here. As I mentioned before, appreciation, it's not guaranteed. Even in Indianapolis, it's not guaranteed. I'm giving you an estimate. I'm using some, albeit favorable market conditions as an example. But the point I'm giving you isn't a specific number necessarily. The point is cash flow alone is not telling you a fraction of the story. And most investors hyper focus on cash flow and never see the rest of the story. So let's talk about that habit that I mentioned at the top. This is something I think you should build once a year, and maybe twice. I encourage it. It really helps once a year to get the full picture of all the benefits. But once a year, fill out, let's call it an annual real estate snapshot for each property you own. It's one page, takes about 10 minutes per property at most. And you just have to track a few things. Maybe 8 or 9 inputs is all we're looking at. This snapshot has 2 sections. The top is going to track your equity position, basically what your property's worth, what you owe, and the gap in between is your equity. And the bottom is going to capture what the property returned that year across all 4 components. So if you need a minute to grab a pen, hit pause. I think this is worth taking a minute, writing this down. Look, and let's be honest, there's tons of models out there to help you do this. I'm just giving you one example. So again, let's start at the top. Let's start with your estimated market value. Write that number down. This is super easy to get. You can use Zillow. Zillow's getting increasingly pretty good at this. There's all kinds of tools out there. I've actually found, strangely enough, Claude to be a great tool for comping properties. I've tested on some of our own properties. I've done, a deep analysis into our MLS system. And then I've tested that on Claude, and Claude came up with numbers that were super similar. So use Claude if you want to. If you have the free version, it's free. But write down your market value. There's a ton of places you can get it. If you're not comfortable with anything online, call us. Our brokers are happy to help you come up with a valuation for your property. Next, take your mortgage statement, write down your mortgage balance. All right, super simple. That third input, you just take your value minus your balance. That's your equity. Track that every year. Make this a sheet that has multiple columns. So year 1, year 2, year 3, year 4. Create an Excel sheet, a Google sheet, whatever you want to do. This is where it gets really fun to track things. Down below, skip a line, go to your annual cash flow. Again, this is what actually hits your bank account. It's net of everything. And be honest, use a real number, not what was on some pro forma, but really get into what your cash flow was for that given year. Next thing, you want to look at your principal pay down. So you look at your mortgage statements from last year to this year. What's your mortgage balance change? It was 175. Now it's down to 172. Write those specific numbers down. They're not going to be that round, I promise you, but write down your annual principal pay down. It's simple math. And then look at your annual appreciation. Again, we talked about that. It's carrying it down. Again, what's your property increase from year 1 to year 2 or year 2 to year 3 and so on. And then this may be a number that may be a little more difficult to get, but probably not. Talk to your CPA and ask just what was my depreciation deduction? What did I save on taxes because I owned this piece of property specifically? And your CPA, they do this for us. They will literally break down every property. They'll run depreciation schedules, which they should, on every property. So you can just plug that number in there. So you add those bottom 4 rows together, and that's your total return. It's really simple. It just tells you what your property did. It's not just what showed up in your bank account again. That's what I want to try to get your mindset away from. It shows you everything. It's a holistic picture of what this property did for your net worth. And again, do it for every property you own. File it away. You can say, again, I strongly suggest doing this electronically. It's a few inputs. It's simple stuff to come up with, because this is the stuff as an investor, I think, that really matters. This is what is giving you, again, the whole picture of how your property is performing. And I'll say this, having done this for many, many, many years, it makes you feel good when you're done, especially you see those mortgage balances decreasing, property values increasing. It just makes you feel good. It makes you feel much better about your investment. And that's how you should feel. We want people to feel very good about their investments. We realize cash flow is a struggle, but if you look at it holistically, which this tool will do, you'll have a much better picture of how it's performing. So think about this. Think about being a landlord as a grind, and this is part of what that grind is getting through years 1, 2, 3, 4, 5, and seeing all that. So that property you bought, as an example, for $220,000 with $44,000 down, maybe in year 8 has $120,000 equity, because your mortgage balance started at 176, it's likely down to about 140. And if the market value trending at the percentages I gave you earlier, your market value may be approaching $280,000 to $290,000. So those two lines, that value going up, your mortgage going down, that's the real story of real estate wealth. And it's only visible, again, if you write it down, if you're telling your story year after year. We've managed hundreds and hundreds of properties in Indianapolis through T&H Realties, and it's the owners who feel best about their portfolios, who have the most clarity, who make the best decisions. They're almost always the people who track this, right? Because they understand that month to month, things are going to be difficult from a cash flow perspective. Year to year now, things can be difficult from a cash flow perspective. But they're writing their story a little differently than other investors. They're tracking things that other investors may not be as disciplined at. And so they feel good each year when they do this, because they know their property quietly is generating more and more wealth. And you really can't call a property a dud unless you know what it's truly returning. And after you fill out this snapshot, especially after a few years of doing it, you're probably not going to call it a dud anymore. We've talked about real estate, air quotes, mistakes that we've made over the years that felt like a really bad buy. But as we've owned it year after year after year, we're so much better off because we bought it. And there's just so many stories like that. And I'm hoping if you're going through a property right now that you feel this way, you kind of change the way you look at it. Maybe you'll say, you know, that property wasn't so bad after all. So again, you don't have to wait till tax time to do this. Do it this week. Just pull out a piece of paper, open a Google sheet, find out what your property's worth, find out what you owe on the property through your mortgage statement so they understand your equity that way. Fill out the rest of the components and just see how it's doing. Just like, here's what I paid for it. Here's where things are now. And I think you're going to feel much better about that property. It really does. It's a great exercise, and I encourage everyone to do it. You know, we've talked about this again, say it again. Real estate builds wealth slowly. What you want it to do, not only to build it slowly, but building it visibly so you can see it each and every year how your property is performing. But you're only going to know that unless you're watching it, unless you have tools set up to really help you monitor this. And it's not hard. It's not rocket science. What we're asking here is a few inputs, and you're going to get a whole lot more clarity on your properties. So again, I'll close with just reiterating again, I hope you can build this habit. Again, it's super simple. Build this habit. You'll be better off for it. It'll change likely your perspective on real estate, and you'll be a happy investor because that's what we like. We hope everyone has picked up some information that will help them in their investing. We'll be back in 2 weeks with another podcast. Until next time, thank you so much for listening, and please stay invested in your investment.